and welcome to the October edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be taking a look at the latest trends and market conditions within U.S. and global energy. And I'll be sharing actionable insights powered by Vortexa's tracking analytics. Today, we're going to take a look at seaborne export flows out of Saudi and Russia. What's happened after the announced pledge to cut 1 million barrels per day and 300,000 barrels per day until December. We'll also take a look at U.S. seaborne crude exports. And in the refined product markets, we're going to take a look at the much talked about Russian diesel exports, diesel coming into Europe, the Middle East grassroots refinery and what does their production look like. And we'll take a look at the export possibilities coming out of China with respect to their clean product export quotas. Now let's take a look at what we're seeing on the crude markets. Now, back in August, Saudi Arabia and Russia announced and pledged to sustain a voluntary cut of 1 million barrels per day for Saudi and 300,000 barrels per day for Russia. Now, these cuts are indeed voluntary until December. However, what we can see, if you look at the left-hand side chart, you can see that Saudi Arabia for the month of September has increased its crude exports by about over 500,000 barrels per day. And Russia has increased its seaborne crude exports by about 100,000 barrels per day. Now, keep in mind, this return of crude exports into the market still comes at a time of a few month lows where we can see those totals trending downwards. Also, at the same time, other OPEC countries have indeed decreased their seaborne crude exports. Now, if we're taking a look at this chart, what we're looking at is a change versus 2022 average in seaborne crude and condensate exports by the main players. And you can see that combined flows month on month have increased compared to 2022 average. And you can also see the downturn that the Saudi exports have taken, although again, they have returned in some amount for the month of September. Now, taking a look at the U.S. seaborne crude exports and what's happening over there. Now, the U.S. and other Americas added 1 million barrels per day of crude exports each since Q1 of 2022. And the Corpus Christi draft increase means an increase in VLCC loads. So what we can see on the left-hand side chart is we can see America's crude and condensate seaboard exports with US being represented by the bars split by destination region. And you can see here that those exports have increased quite dramatically up to over 4 million barrels per day, while other America's exports have also seen an increase in the last couple of years. So we see that trend continuing to some level, especially as Corpus Christi is allowed to now load VLCCs at larger volumes, as well as Suez Maxes in October. So on the right-hand side chart, what we can see is we can see those U.S. crude and condensate exports by origin port. And the blue represents those load ports out of Corpus Christi, and as well as the gold bar represents Houston. But you can see the jump in the blue bar quite substantially from August until September, and we expect those volumes to continue moving upward. Now let's take a look at what's happening on the refined product market. And we're going to start with the much talked about recent announced ban on Russian exports of diesel and gasoline. Now, since the ban was announced on September 21st, the ban for diesel exports has been somewhat tailed back, even possibly revoked. However, let's take a look at what we're actually seeing from the world's biggest supplier of diesel. So if you look on the left-hand side chart, you can see this red line that really diesel exports out of Russia for the current year have been in extremely elevated values. You can see that as soon as the European diesel Russian import ban went into place in February, that those exports shot up, fell down in May, but that was due to maintenance, and then have since then increased largely above that 7-year range and well above last year's value. Even with the ban, we did see exports dropping, loadings on a daily basis dropping. However, what that really moves into in terms of a monthly average really doesn't do a lot in terms of damaging that downfall of export. So we still see large volumes of exports coming out of Russia, especially for diesel. Now, on the gasoline side, the gasoline export ban, I believe, is still in place. However, the gasoline exports for the global market are fairly insignificant from Russia. So Russia exports on average about 100 plus thousand barrels per day of gasoline and blending exports. It's relatively small quantities. We've seen move to somewhat Middle East, West Africa, Singapore. We think they get probably blended and used domestically. Now let's take a look at what's happening in the Chinese market. Now, one of the big questions on the market has been, will China boost diesel exports without additional quotas in Q4? And our Singapore office points out that China's exports of gasoline, diesel, and jet fuel remain moderate in the first half of this year, as you can see by this chart. And this is amongst a rapid recovery in domestic fuel demand after China's reopening and relatively weak export margins. Now, exports only started picking up in Q3 after Asia's product cracks rebounded from lows at the end of May. Now, Chinese refiners may continue to increase exports in October, as the remaining quotas for Q4 are estimated at above 10 million tons. And some refiners may still be allowed to convert some remaining export quotas for low sulfur fuel oil to clean product export quotas. Now, the sharp decline in Asian gasoline cracks in recent weeks, contrasting against stable middle distillate cracks, is also an incentive for refiners to increase exports of diesel and jet fuel at the expense of gasoline. Now, let's take a look at product loadings from the Middle Eastern grassroots refineries. Now, they do reach new highs in September, although transport fuels remain relatively low. So here, if you look on this chart of product loadings from Middle Eastern grassroots refineries, you see that by refineries, the exports, the product loadings from these refineries reached some of their highest levels in September. And this is from Jizan, the Kuwait refinery, and the Duqm refinery in Oman. Now, on the right-hand side chart, what you can see is you can see product loadings from these grassroots refineries by product. And this is where it gets interesting to see this level of detail. So you can see in September that relatively stable month-on-month volumes of diesel have been loaded out of these refineries. However, we would expect these numbers to rise in the future as these refineries ramp up their secondary units. Now, another limitation, of course, to Middle Eastern exports in general is a relatively high refinery maintenance season that we're currently in October. It started in September and will be lasting until October. And we're also seeing refineries in India, especially West Coast India, offline for maintenance as well. You could see this resulting in the flows, especially the Indian clean product exports, which in the red line have decreased sharply since August, falling below last year's values. Now, this is likely to linger or even deepen in October as the maintenance continues. Now let's take a look about the much anticipated question of diesel and jet kero flows into the Atlantic Basin, especially out of the East of Suez markets. And here on the left-hand side chart, you can see Atlantic Basin imports of diesel specifically from the Middle East and Asian markets. And notice that larger volumes in the last couple of months have especially come to the UK Cont. We've also noticed steady volumes coming into the West Med, the East Med, and an increased volume coming in to West Africa. Now, on the right-hand side chart, we're looking at Atlantic Basin imports of jet kero from the Middle East and Asia, and you could see those volumes fairly robust, rising quite strongly through the summer, and then falling in the last couple of months as the travel season wanes. Now turning our attention to the America's East Coast for a look at what gasoline imports have looked like this season. So on the left-hand side chart, we can see PADD 1 in East Coast Canada gasoline and blending components were above last year's values, and even above the 7-year range here or the 7-year average rather, in the blue line. This is largely a result of higher demand for gasoline in the region, especially in PADD 1, lower retail prices than were at the pump last year. And then also, of course, we had some big FCC outages in the region this summer, and also plan outages currently going on for PADD 1 and East Coast Canada. Now we expect these flows to continue to be curtailed until we hit the Thanksgiving holiday, which is kind of the next pop in imports. Now, on the right-hand side chart, you're looking at a U.S. Gulf Coast. So this is mainly the east coast of Mexico, South America, East Coast, and the Caribbean imports of gasoline and blending components. And what we can see here is a different story. And we can see that this year, imports to this region have largely surpassed the 7-year range and definitely have surged above last year's values. This is really quite telling of the demand we're seeing, especially from Mexico, not just demand, but also due to the lack of refining capacity. Mexico's refineries have been hit by fires this year and have largely been running at below 50% utilization. Now, taking a look at America's West Coast, we're seeing clean product imports surge past last year's values, and this is underpinned mainly by the exceptional demand for diesel that we're seeing in this area. Now, America's West Coast does include Alaska, PADD 5, and Peru, Ecuador, Chile as well. And this is really where these imports or the import demand is coming from, is mainly that Latin America demand. Also included in that, of course, is West Coast Mexico. Now, on the right-hand side chart, what we're seeing which products are in demand. And you can see that diesel increases in the last couple of months in the dark blue. And you can see in the gold color that gasoline and blending component import demand is still very strong. Now, looking at these lines, we can see where the imports are coming from. And largely in this sort of dark pink line, you can see relatively high volumes coming out of PADD 5. And this is predominantly diesel volumes coming into West Coast Latin America, meeting that demand. Now, from the red line, you can see these large volumes coming in from PADD 3, and this is fairly split amongst gasoline and diesel. You see the import demand take a dip during the summer, but it's gone back up recently in the last few months. In addition, you also see large volumes of imports and growing volume of imports coming from the Asian markets as well into West Coast Latin America. Now, last but not least, we're going to take a look at, very quickly, U.S. LPG exports to Europe. And we can see this rising strength of U.S. LPG exports to Europe, despite the highest freight prices we've seen since January 2023. So on the right-hand side chart, what you can see is the U.S. Gulf Coast ballast VLGC availability and the U.S. Gulf to continent freight rate. And you can see how that freight rate has rapidly increased, but not to deter those U.S. LPG exports from coming over to Europe. Well, that's all we have for you today. Thank you for watching, and please like and subscribe, or feel free to suggest any changes to our topics. Thank you very much. Bye-bye.